Good morning. Thank you for uh, logging in to the not-for-profit revenue recognition webinar that Carr, and Ingram is putting on this morning, and we're glad you're here. My name is Ray Roberts. I'm the industry line leader for the not-for-profit area, and we just welcome you, and hopefully this next hour will give you some good information about how to get your organization and your selves ready to implement these new standards. We do have a lot of information today to discuss, and we're going to talk. The presenters I'm going to moderate the deal, and Alyssa Hill, a partner from our Houston office, is going to participate as a speaker, and Lorri Kidder from our Bradenton, Florida office is going to participate and help you learn more and more about this revenue recognition issue. So some logistics. We have a lot of information, so we're going to be blasting through a lot of this. So we have 1 hour to complete, and we have some polling questions that you have to answer to get CPE credit for attending this. So watch out for those as they come up, and we'll have quick turnaround on those because of the time crunch. And then also you'll be receiving CPE certificates after the webinar through your email. So watch out for that. So if you don't get it, you can reach out to us and we'll help you find that, or you can check your junk mail. It might have went in through there. So we're going to go quickly through these sections, and our agenda today is going to be, we're just going to give you a brief overview. We're going to talk about ASU 2018-08, which is talking about contributions for not-for-profits, and then topic 606, which is the actual revenue recognition standard that both of these are implemented starting at the end of this fiscal year. We'll talk a little bit about transition between the old ways and the new ways, and what the AICPA and the FASB has allowed us to do in that transition. And in addition, the implementation tips, some things that we've learned on the ones that we've already implemented on behalf of some of our clients. So that's going to be the agenda for the day. Some of the overview, the objectives are twofold, really, is to identify the impact of potential application of consideration of new revenue recognition standards to your organization. What effect will it have on your organization? And in addition to that, what effect will it have on your financial statements and the related disclosures? Okay, there's going to be a lot of work behind the scenes to understand these standards, but it's all going to show up in your financial statement and your disclosures. So keep that in mind. There's going to be really two main objectives here in this presentation. So some of the discussion topics, we're going to talk about 2014-09 revenue recognition, or the topic 606, and of course the 2018-08, which is revenue recognition of grants and contracts by not-for-profit entities and how they can impact your not-for-profit. So in addition, we're going to spend quite a bit of time on the 5 steps of the revenue recognition, or topic 606, and the impact it has on program service fees. A big key this year is determination of whether a grant or contract is an exchange or non-exchange transaction. And finally, we're going to consider the impact on revenue recognition with donor-imposed restrictions and when a barrier or a right of return exists. Those are key things you'll learn about today. So that being said, I think we'll go ahead and get started on this presentation. Again, thank you.
Okay, so this is Lorri. Revenue recognition changes under topic 606. This impacts all entities, whether they're public, private, or nonprofit. Contributions are excluded. We're going to talk about those separately when we talk about ASU 2018-08. And certain transactions under topic 606 may require bifurcation, meaning there may be a piece of contribution in that we need to consider separately. But we're going to talk about that in a few minutes. In addition, under revenue recognition changes, under ASU 2018-08, this was issued in June of 2018. It addresses difficulty and diversity in the practice among nonprofits and how they're recognizing contributions. The first issue is that the standard will help us distinguish between a reciprocal or an exchange transaction versus a non-reciprocal or a contribution transaction. And then in the second issue, we'll be distinguishing between conditional versus unconditional contributions, and this ASU helps us with both of those. The effective date for both standards, being ASU 2018-08 and Topic 606, are fiscal years beginning after December 15th, 2018. So if you are a calendar year, this has been in effect for all of 2019. Okay, Alyssa.
Great, thank you, Lorri. Well, Lorri and Ray have just given you quite a few terminology, quite a few ASU numbers, Topic 606. We've thrown a lot out at you. But to get you thinking about where your revenues may fall, on the left, you'll see categories that are within the scope of Topic 606, because these are considered exchange transactions. You're giving something in exchange for the funds that you're receiving. So that's going to be your tuition, your membership dues, program fees, some exchange grants. On the right, these are types of revenue streams that are within other standards, such as contributions and non-exchange grants. Those are both under that ASU 2018-08 that we're going to talk about this morning. Notice you actually have grants in both columns. If it's an exchange grant, it's going to be in Topic 606. If it's a non-exchange grant, it's going to fall under the other ASU, and we're going to go through some examples of both of those. And then you've got revenue streams like leases, insurance, and they have their own standards to follow for how revenue is recognized. We're not going to touch on those this morning. Notice there's a couple of asterisks on the left-hand side next to membership dues and sponsorship agreements. These could actually have components of either both an exchange or a contribution. Lorri just mentioned that. So those are types of revenues where you may have to consider both of these standards when you're looking at that revenue and when and how that revenue ultimately gets recognized. So before we get into too much of the detail, I think we've got our first polling question.
Great, thanks, Alyssa. The first question, as you can see, is what is the effective date of the new revenue recognition standard? A, calendar year 2019. B, calendar year 2020. C, whenever we want. Or D, never. So we're doing pretty good on this. This will be the first of multiple polling questions, and looks like we've got 80–90% of the answers in already, or 80% of them voted. So give it a couple more seconds and we'll get this closed out, and we'll get to 85 and we'll be closing it out. All right, looks like we can close this poll. It looks like we have an answer. The first answer is correct. The calendar year 2019 is the right answer. 81% of the attendees voted that way.
Okay, so we're going to start talking a little bit about ASU 2018-08, and on the next slide we're going to look at some of the basic concepts. And the contribution is an unconditional transfer of cash or other assets, as well as unconditional promises to give to an entity, or a reduction, a settlement, or cancellation of its liabilities in a voluntary, non-reciprocal transfer by another entity acting other than as the owner. Whereas an exchange transaction those are reciprocal transfers in which each party receives and sacrifices approximate commensurate value. So need to keep in mind that the transfer of assets, it could be from the liability side. It could be a settlement of liabilities. It would have to be both voluntary and non-reciprocal to be considered a contribution, versus an exchange where, which are reciprocal because both parties receive and sacrifice approximate commensurate value. So on the next slide here, we're going to look a little bit at kind of some examples of exchange versus contributions. And due to the new definitions related to revenue, nonprofits implementing the standard may need to reevaluate their classification of grants between exchange transactions and contributions. Those grants that previously fit the criteria of exchange transactions may better align with the definition of a conditional contribution rather than that of a contract with a customer. So as we look at this, an exchange is an expressed intent of both parties to exchange resources for goods or services that are of commensurate value, whereas the contribution, the provider is transferring funds for activities consistent with its mission or obtaining positive sentiment, but it's not commensurate value. Another, under exchange, both the recipient and the provider agree on the amount of assets transferred in exchange for goods and services. But as a contribution, the provider has full discretion in determining the amount of the transferred assets. And when we go back to the exchange, you could have penalties in excess of the amount of the asset transferred by the provider. And under a contribution, any penalties would be limited to the delivery of the assets or services already provided and the return of the unspent funds. So an exchange is where the donor receives a benefit while a contribution is for the benefit of the general public. And that's important to remember. I think we're going on to conditions and barriers with Alyssa.
Okay, great. So as Lorri just went through helping you determine your agreement of, whether it's an exchange transaction or a contribution, once you determine it's a non-exchange transaction, the second piece you've got to then determine is whether or not it is a conditional or an unconditional grant or an unconditional contribution. Okay, so in order for the contribution to be considered conditional, it must have both. It has to have one or more barriers that must be overcome before the recipient is entitled to the assets transferred or promised, and there has to be a right of return to the provider for the assets transferred or some type of right of release of the obligation to transfer the assets. The old rules for what was considered conditional, those no longer apply. So that, was it less than remote, more than remote, all of that, that definition, that has gone away. This is now your definition of conditional, and in determining whether or not your grant or your contribution is conditional versus unconditional. One thing that hasn't changed are you still can have donor-imposed restrictions. Okay, restrictions are different from barriers, and we're going to talk about what the difference is and really what a barrier is on the next slide. But you can still have donor-imposed restrictions. They can still have a right of return if you don't use the funds as you're supposed to, but if it's a restriction and not a barrier, then it's not conditional. Okay, so donor restrictions, they're there just as they always have been in the past. Okay. So let's talk a little bit about barriers. Okay. So just like Lorri showed us with the ASU giving us indicators for determining if a transaction is, a contribution or exchange, the standard also gives us indicators for determining barriers. Okay, and there's three. There's a measurable, limited discretion, and then a purpose barrier. Measurable barriers, these are going to be you have to achieve a specified level of service. Maybe you have to provide a certain number of units of outputs, matching requirements. This still applies. You get a grant for $500,000, but you don't get it until you raise another $500,000. That matching requirement, that still applies, and that would be an example of a measurable barrier. Okay. Your second category is limited discretion, and this is going to be more specific than just a donor-imposed restriction. An example here would be when you have to follow specific guidelines to incur qualifying expenses. So think about your government grants that have uniform guidance, OMB requirements. There are usually some pretty specific requirements that you have to follow. That would be more indicative of a limited discretion barrier. Maybe you've got some research grants. You have to adhere to specific protocols, hire qualified people, that type of thing. That could be a limited discretion barrier as well. And then finally, your purpose barrier, and this is going to be something that is directly relates to the purpose of the agreement. A lot of your research study grants would likely fall into, could fall into this category. Okay. Real important to know, what is not a barrier, would be any trivial or administrative stipulations. So this would include routine reporting on expenditures, filing your annual audit. These are not directly in conduct to the grant, so these are considered administrative, and these are excluded. These are not barriers. The standard is clear on this. These are not considered barriers. Okay, so as you're thinking through all these things, guess what? Professional judgment is likely going to be required when you're thinking about these barriers. Some may be very clear-cut, others may not so much. One way I like to think about it is that conditions, they're going to place limitations on how the funds are spent or maybe require benchmarks to be met, whereas just a restriction is really going to specify only the activity or the time, but not necessarily the way you perform that activity. Okay, but again, you're going to have to use some professional judgment. That's probably going to be required in some of your grant agreements, but it's real important. You've got to think barriers versus restrictions in considering whether a grant is conditional. All right, so on our next slide, we've got a great decision tree courtesy of the AICPA. There's also one similar to this in the standard itself. So what we've been talking about in this first part is really the second half of this decision tree. At the top, we've said whether or not is an exchange, is commensurate value being exchanged, and when we say no, then we're going down and we're saying, okay, this is likely considered a contribution. So we need to look at 2018-08, which then first thing is, do we have conditions? So again, both. Do you have that barrier and right of return? If you do, that is a conditional grant or a conditional contribution, whatever you want to call it, and you would not recognize revenue until that condition is met. Okay, so maybe a grantor gave you some funding up front, but if you do not meet both of those criteria and it's conditional, then you're going to have a liability on your books until that condition is met. On the flip side, if you do not have both a barrier and a right of return, then you've got to look and say, okay, is my contribution, my unconditional contribution, are there any restrictions? Is that purpose or timing? And then that will guide you as to whether or not you record it as with donor restriction or without donor restriction. So I think what we're going to do is move into a few examples to walk you through to get you thinking about these different concepts with some examples. All right, so our first one is a university was awarded a research grant from the federal government. This agreement requires the university to follow the rules and regulations by the OMB. They can only incur certain costs that comply with all of those wonderful rules and regulations. We have to submit an annual audit, and we have to let the federal grantor know, our research findings. Any unused funds are forfeited, and if there's any unallowable costs are incurred, we're going to have to refund those amounts. Okay, but the university does, in this case, retain the rights to the findings. Okay, so based on these facts, you would need to determine if you have an exchange grant. So is the federal grantor receiving commensurate value or something directly in return for the funds it's providing? Or is this grant really more representative of a non-exchange transaction, more of a contribution that you would have to then determine, is it conditional or unconditional? Okay, so our solution or conclusion is that this is actually a non-exchange grant. Why? Main bullet, first one, commensurate value is not exchanged. The university is keeping the rights to the finding, and one thing to keep in mind is the federal government or local government or state government, but the government agency is not the same as the general public. So in this case, the benefits are considered indirect because the benefits serve the general public and not that federal grantor. Okay. So now that we know it's non-exchange, we have to say, is it conditional or unconditional? And in this case, we have a conditional grant. And the reason being is we have likely that limited discretion barrier because we have to incur those qualifying expenses, and we have that right of return or release. Okay, so you have the and. You've got the barrier and the right of return. The last item that was mentioned in the facts was an audit, and that alone, remember, that's an administrative, that's trivial. That is not a reason why a grant is conditional. Okay, so that's listed, but that's not the reason why you have a conditional grant. It's the previous two items. All right, so on our next example, we've got a grant from a local government, and this is going to be our nonprofit got this grant to study the benefits of a longer school year. The nonprofit's going to plan the study, perform the research, submit all the results back to the local government, and the local government in this case is retaining all rights to the study. So what do we think? Is this transaction an exchange or a non-exchange? And again, if it's non-exchange, then is it conditional or unconditional? So in contrast to our previous example, this is actually considered an exchange transaction. And the reason being is that there is commensurate value being exchanged between the two parties as that local government retains the right to the studies. So in this case, they give money to the nonprofit organization. The organization did everything, but the government is receiving the benefit because they're getting the rights to the study to then go, determine whether or not they want to have a longer school year. So in this example, once we determine in its exchange transaction, conditional barriers, right of return, none of that matters because this grant now applies under Topic 606. It does not apply under the ASU 2018-08 that we've been discussing thus far. But not to worry, we're going to get into Topic 606. But just note how these slight differences in determining where your agreements fall can trigger which revenue recognition standards you may have to follow. Right. So, Lorri, you want to do our next example?
Yes, we're going to go through 3 different scenarios regarding fundraising revenues. So we have a not-for-profit A. They are dedicated to building awareness on protecting the beach environment and expanding the Adopt a Beach program. Every year, the organization holds an annual event that includes performances by major entertainers. This event generates contributions and sponsorships by major contributions. The not-for-profit engaged in the following transactions during the year ending December 31st, 2019. So the first arrangement, contract number 1, is with Turtles R Us. If you want to flip to the next slide, Ray, there we go. On April 1st, 2019, Turtles R Us pledged $2 million for the event. The purpose of the pledge was to fund activities consistent with the organization's mission. Turtles R Us provided $1 million when the grant was signed and promised to provide $400,000 on April 1st, 2020, and $600,000 on April 1st, 2021. The future pledge payments will be made only after the organization provides progress reports in accordance with the agreement, which are due by March 1st of each year. So in this instance, the pledge from Turtles R Us meets the definition of a contribution, as it is an unconditional transfer of cash that is both voluntary and it's non-reciprocal. Remember, the progress reports do not create a barrier that would defer revenue recognition, as it's considered an administrative matter, and administrative matters are not considered a barrier. But there is a timing restriction that we will take into account relating to the amounts due in the future in 2020 and 2021, and they would be reflected as with donor restriction contributions. So in our next example, contract number 2 is with Seafood Warehouse. Seafood Warehouse is a supplier of seafood throughout the Gulf Coast, and they've pledged $600,000 for the event. The not-for-profit has to perform specific activities which are consistent with its normal operation. The not-for-profit must identify Seafood Warehouse as a sponsor of the event on its website and in its newsletters, and Seafood Warehouse can publicize its participation in its own advertising. Seafood Warehouse did not receive any other benefits such as free tickets to the event as a result of this sponsorship. So based on these factors, this is also considered a contribution. Seafood Warehouse's sole benefit is good publicity, which does not constitute commensurate value. Absent any donor-imposed restrictions, the grant would be recorded as a contribution without donor restriction. Okay, now we'll look at our third contract, which is with Dawning of a New Day. D&D is a manufacturer of consumer cleansing products, and they've pledged $2 million for the event. The requirements include the same specific activities and advertising as the nonprofit has with Seafood Warehouse. But D&D has some additional requirements. D&D is going to have dedicated space and time at the event to showcase its cleansing products. The not-for-profit must announce D&D as a platinum sponsor and its ongoing commitment to the Adopt a Beach program. The agreement has terms can be revised if a third-party competitor proposes to sponsor the event, and penalties to breaches are specified by the agreement. So in this case, do you think that this is the same as with Seafood Warehouse? Is this a contribution? Not quite. This actually is considered an exchange transaction because D&D is considered to be receiving commensurate value by being able to promote itself and its products at the event. As a result, the not-for-profit must follow Topic 606 for determining proper revenue recognition. And as Alyssa has mentioned before, conditions and barriers are not going to apply because we're following Topic 606, and therefore we're going to be considering performance obligations, which we'll be talking about that in just a few minutes. So on the next slide, just the conclusions. We'll go over those real quick. So with contract number 1, Turtles R Us, we have a contribution. It's unconditional. We do have amounts due in the future that will be reported as with donor restriction. Contract number 2, Seafood Warehouse, it's a contribution. It is unconditional, but it's absent any restrictions, and therefore it would be reported as without donor restrictions. And then the last contract, Dawning of a New Day, that is an exchange transaction, and we are going to follow Topic 606, and we'll record revenue based on when performance obligations have been completed. With that, I believe we have another polling question to do real quickly. There we go.
All right. Thank you, Lorri and Alyssa. So far, it's going great. The new program polling questions up on the screen now, and it says, an exchange transaction is when a donor receives the benefit, while a contribution is for the benefit of the general public. Is that true or false? So we have some time here. This is something that wasn't necessarily on a slide, but Alyssa said it, so you might want to watch out to see if you can think back and see how that was. We have 60% of the people have voted already. We do appreciate the attendance on this and the participation. We are going pretty good on timing, so if we could, if you have any questions, feel free to. We might be able to get to them. We don't know how the second half's going to go, but if you have any questions, we sure will get back to you before too long. After, if it's not during the presentation, it would be afterwards. So we got 85% of the vote in, and we'll go ahead and close that out, and we can go on. But right now we have 87% said true, and that is the right answer. A exchange transaction is when a donor receives the benefit, while a contribution is for the benefit of the general public. So good job on that part of it.
Okay, so now we're going to move into revenue recognition under Topic 606. So the core principle under this revenue recognition model is that we're going to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And we have 5 steps that we're going to apply to the core principle. And we're going to talk about each one of these in a little more detail, but we're going to identify the contract, we're going to identify the performance obligations, and then number 3 is determine the transaction price, then we're going to allocate that transaction price, and last we will recognize revenue when or as the performance obligation is satisfied. So let's go into just a little more detail here on the 5-step process. So in step 1, again, we're going to identify the contract. And a contract is an agreement between parties that creates enforceable rights and obligations, and it may be written, verbal, or implied by customary business practices. After we identify the contracts, we're going to identify the parties, and the rights regarding the goods or services to be transferred. We're going to identify the payment terms for the goods or services to be transferred. And we're also going to consider the probability that the entity will collect substantially all of the consideration it is entitled to for those goods and services to be transferred. And then under step 2, we're going to identify the performance obligations. And so we are going to identify all explicitly and implicitly promised goods or services in the contract. We need to consider if it's a good or service is distinct, that it stands alone, or is it part of a bundle? Is it a series of goods or services that are substantially the same and that have the same pattern of transfer to the customer? These are some of the things that we would consider in step 2. And then we would move on to step 3 to determine the transaction price. So we could have fixed consideration. There's also variable consideration, which could mean, could relate to discounts, rebates, refunds, price concessions, incentives, etc., things like that, as well as non-cash considerations. So the transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding the amounts collected on behalf of third parties. So let's look at step 4. Step 4 is the allocation of the transaction price. So the transaction price is going to be allocated to the separate performance obligations based on the relative standalone pricing. And when we do that, we want to maximize the use of observable inputs. We want to apply them consistently. And there's probably going to be some estimation in here, but we want to use the observable inputs as much as we can. And then we may also, in this, have some discounts that need to be allocated, so we would consider those as well. And then in step 5, revenue, is to recognize revenue when the performance obligation is satisfied. And basically, revenue is going to be recognized when or as each performance obligation is satisfied, either over a period of time or at a point in time as promised goods or services are transferred to the customer and the customer obtains control of the goods or services. So we are now going to go through a few examples that I think will help illustrate these 5 steps and give you a little more understanding.
Great, thank you, Lorri.
Okay.
So our first example relates to museum memberships. And if you think back to one of the first slides we started with, what was within the scope of ASC Topic 606 and outside the scope, that left-hand column. Remember, membership dues, tuition and fees, certain grants, those were on that left-hand side because in those situations there is commensurate value, there is an exchange occurring because you're receiving funds for your membership dues, whether it's a museum or a trade association or any type of association, and then the person that's giving that to you, that individual or that corporation, is receiving something in exchange. So in this case, what we have is we have a museum that offers an annual membership for $500. And this museum, like many museums, they will take your money any day of the week, okay? They're not going to wait for you. You know, you don't have to wait till the first of the month or to the first of the fiscal year. They'll take your money if you want to become a member today, okay? So with that $500 annual membership, you are going to receive free admission to the 4 special exhibits. There's 4 a year. You're going to get a quarterly newsletter. You're going to get a 20% discount on art classes, and you're also going to get tickets to 2 events that occur during the year. Okay, so these are the facts, and now let's take these facts and walk through the 5-step process. All right, so step 1, Lorri mentioned we've got to identify the contract, and so in this case, it is our annual membership to the museum. In step 2, we've got to identify the performance obligations. So that's going back to those facts and saying, you know, what are we giving for that annual membership? So there's four performance obligations, 4 different things that you are providing to the members for that $500. Okay, so once you've identified those performance obligations, then you've got to determine the transaction price. And you're going to do this for each performance obligation. And this could be done in various ways. It may be stated prices. So like the stated admission for non-members is $10. So you can determine what the value of those free admissions are based on stated prices. But maybe you've got to determine based on fair value, what are your costs into the newsletter. So that may be there may be a little bit more to that to determine what the fair value is. Real important, make sure you have a basis to support what you're using to determine these different transaction prices, whether it's a stated value or a fair value. Your auditors are going to ask. We're going to ask. So just a little tidbit, make sure you're documenting what you're determining. Okay. The 20% discount, this is actually a combination. You've got a stated non-member price for how much the classes classes are, but then you've also got to look and say, historically, how many times does a member actually use this? Because the 20% discount was unlimited, but on average, your records show 2 classes. Each member kind of takes 2 classes. So you've determined a transaction price related to that performance obligation. And then your last one, your tickets. Again, you've got a stated price for people to attend those events. On average, they're $35 a ticket. So you come up with the transaction price for that last performance obligation. Okay. Why does this matter? Why do we care? Because depending on all of this, this could impact when revenue is ultimately recognized. Okay. So let's move on to step 4, because we still haven't gotten to recognizing any revenue. We're only on step 4. All right, so now we've got to allocate our transaction price among the $500 that we received. And so this just walks through each of the performance obligations, and then notice that we had some money left over. Those 4 items didn't get us to $500. So that remaining $112 is considered a contribution. So that's where this bifurcation, looking at if you've got revenues that may fall under both, here's an example, because when it was all said and done, what you are obligated to that member, there is a portion that is just considered an additional contribution. Okay, what happens if you were to go through this exercise and all of those items came up to more than $500? Well, then that's where there's a discount associated with that. Lorri mentioned that as she was going through the 5 steps. So then you would discount each of those individual prices back down to the $500 that you received. Okay, so now that we know what all of our transaction prices are, step 5, we finally get to determine when we get to recognize our revenue. Okay, so in this case, that $112, that's a contribution. You're going to recognize it the day that membership is paid. Okay, so you get that on day 1. However, your other performance obligations, if you think about what we've just talked through, they are over periods or a point in time. So you are not recognizing that full $500 on day 1. The $80 for the newsletter is going to be recognized quarterly, and the amounts for the free admission, the art classes, the tickets, those are going to be recognized as revenue when they're used by the member or at the point the period has passed that the performance obligation could be satisfied. Okay? You're going to have a method to track this. If this is a situation that applies to you or some type of similar situation, you're going to have information to track to know when you can recognize that revenue. So it's either recognized at the point in time it's used or at the point that it is forfeited and can no longer be used. So they didn't come to the special event, you would recognize that revenue once that event had passed. All right, so in conclusion on this, what have you historically done? On the next slide, you would have recognized $500 ratably over the 12-month membership period, right? That's what you would have done. $500, $1,000, $10,000. You would have said, great, I'm going to recognize 1/12 of that each month. But under the new standard, as we just went through, there's different points in time when revenue is recognized. Okay, so that's why it's important to go through the 5-step process to identify your performance obligations, determine the transaction price, and then ultimately know when revenue is recognized. Now, If your due cycle is the same as your fiscal year, likely there's not an impact. Okay, so for any, for anything that follows your fiscal year, your $500 is your $500. But if you don't renew on your fiscal year date, if somebody can become a member at any point in time, or you have a sponsorship agreement that runs at different periods in your fiscal year, you're going to have to go through the 5-step process, because likely you will have revenue that could either be accelerated or delayed from historically when you have reported it.
Okay, thank you, Alyssa. That was a great example. I love that one. We've got another not-for-profit industry example having to do with tuition and fees. So the facts in this situation: the student has been accepted to a not-for-profit college. After the new student orientation, the student registers for the classes and received a tuition statement of $10,000 for the fall semester. The college charges an additional $200 in student fees, and the related books for the registered classes will be an additional $300. Students can withdraw at no charge within the first 2 weeks of the semester. So let's walk through our 5-step process on the next slide. There we go. So our contract, we have a contract exists for tuition and the fees after withdrawal period ends. It's cancelable until that point in time within that 2-week withdrawal period. There's no contract related to the books until they're ordered or purchased. So then we're going to identify the performance obligations. So the college has the obligation to provide classes to the students and other student services, and to provide access to the textbook provider. Those are our performance obligations. So now we're going to determine the transaction price with step 3. The fair value of the tuition and the fees is $10,200 based on our facts. And the fair value of the books is $300. So in step 4, we allocate the transaction price. $10,000 is allocated to the performance obligation to provide classes. $200 is allocated to provide student services, and $300 is allocated to the textbooks. So then we're ready for step 5 to recognize revenue. So the $10,200 for the students, for the tuition and the student fees, those are going to be recognized ratably over the semester once the withdrawal period ends. And the $300 for the books is recognized at the time of purchase. So what this would mean that if we received the $10,200, then that would be a liability until the 2-week period passed the withdrawal period, and then we would recognize the revenue for the $10,200 for the tuition and the fees once that withdrawal period is over. Okay, so differences from the current GAAP or previous GAAP. Again, the tuition and fees are recognized as AR, and deferred revenue, I said a liability. Deferred revenue is a liability. When students register for classes, and then it will be recognized ratably over that semester or the term of the classes. The books are going to be recognized when purchased, so there's no change there. And then updated is the tuition and fees are recognized when the withdrawal period ends. Again, you would have a liability until the withdrawal period ends if the student paid ahead of that, and then you would recognize the revenue. And if tuition is prepaid, the performance obligation is recognized, which I just said that previously. So if the school calendar and fiscal year align, there would be no changes, and there's the potential impact for summer classes in that we would no longer be grossing up the balance sheet for those summer classes. Okay, and then I think we are going back to Alyssa to talk some about the transition.
I think we've got a poll question first.
Poll question first. Yeah, we have a polling question.
I'm sorry.
Okay, we're about to launch this third polling question. And the question is which of the following is not part of the 5-step process under topic 606? A, allocate the transaction price. B, identify the performance obligation. C, determine if any conditions or barriers exist. And D, and that's, can't read D. So we got 38, 43%.
Yeah, D, determine the
D is
transaction price.
Determine price. Yeah, it got cut off on my list. So, so if 61%, 62%. So we're working through this. Now we're looking at the 5-step process here, and which one is not part of the 5-step process. So we have 71% voting, and we got a little bit of mixture on what's going on the.
Remember, we're just talking about the 5-step process under topic 606.
Right.
You don't want to get confused with 2018-08 on contributions.
Okay, looks like we have 80+% voted, and if we can go ahead and close that out. We have 68% of you thought determine if any of the conditions or barriers exist, and that's the correct answer because it's not part of the 5-step process. That's when you have a contribution or a non-exchange transaction. So pretty good response on that one. So remember, no condition or barriers in the 5-step process. All right, let's go ahead to the next section of the presentation on the transition between the old and the new.
Great, thanks, Ray. Okay, so we have thrown out a lot of terms, a lot of examples. You are probably thinking about all of your different revenue streams and going, which ones do I need to worry about? Which ones, which ones am I going to impact? Which ones do I have to go back and look at? So we're going to talk about the transition approach. As I mentioned, standard is effective for 2019 calendar year entities. So if you are if you're a calendar year, we need to be on top of this. Okay. In adopting this standard, a modified prospective approach is considered acceptable. Okay. So what does that mean? Under this approach, you are going to apply the new rules, so everything we just talked about, to all agreements that existed at the effective date. And it's only going to apply to the portion of with existing agreements where revenue hasn't already been recognized. Okay, and then obviously any new agreements entered into after the effective date. Okay, so existing agreements where we still have revenue to recognize, and new agreements. Those are the ones that you're going to have to be concerned with in this transition. Okay, you're not prior period results are not going to be restated. Okay, so as you can probably imagine, as your head is spinning through all of this, there may be shifts in when you are recognizing revenue now versus historically. Okay, so not to worry, your financial statements are going to have additional disclosures that will help the users understand what changes, or how your financial statements were impacted by adopting the new standard. So just like you all, everyone saw this past year with adopting the financial statement presentation standard, we had a change in accounting principle disclosed. You're going to have something again similar this next year for revenue recognition. You are also going to have note disclosures that explain which financial statement line items or areas were impacted by the changes in this guidance. Okay, so if all of a sudden revenue is accelerated or or slowed down, your notes will provide additional explanation, again, to help the users understand those changes. Okay, so what we're going to do, we've got a few minutes left of our hours, so before we move into the implementation tips, we're going to go through three quick examples on what the modified prospective transition might look like. So on our first example, again, our nonprofit's going to adopt the new standard in 2019, and in 2018, they actually received a 3-year grant that they were going to get $100,000 annually through 2020. So under the old rules, the nonprofit treated this grant as an unconditional contribution, and they recognized the full $300,000 in 2018. Okay. So in the year of adoption, in this scenario, no changes are required. The grant is considered a completed agreement. all the revenue's already been recognized in 2018. You are not going to go back and determine, well, how should it have been based on the new rules. This is a completed agreement, okay? So you're just going to continue to release the installment payments, from net assets with restrictions when the payments are received, okay? So this is one of those examples. Revenue was already fully recognized. You don't have to do anything under the modified prospective approach. Okay. Our second example, again, adopted in 2019 and in 2018. In this situation, the organization received a grant that would provide for $50,000 per year for 5 years. Okay, so at the time of the grant award in 2018, the nonprofit considered this an exchange transaction, and revenue was only recognized when it was billed. Okay, so that means that at the date of adoption, only $50,000 of this had been recognized. So it is not a completed agreement. There's still more revenue to be recognized. So in this case, the organization needs to relook at this contract to determine, is it still an exchange transaction, or is it possibly a non-exchange transaction? And then if it's non-exchange, is it conditional or unconditional? Okay. So the nonprofit went through, looked at their agreement, and now they actually consider, based on the new definitions, it's really a conditional contribution. Okay. So maybe it's like our first example that we talked about with the grant from the federal government for the research. Okay. So whatever was in that agreement, there's a barrier and a right of return. They consider it a conditional contribution. So in this case, what do we learn? We learned that they're going to recognize that remaining revenue as conditions are met. So whether that's all in 1 year, over the next 4 years, they're going to recognize that as revenue when conditions are met. Likely, based on these limited factors, there's probably not any real difference in the timing of revenue recognition, but it is no longer considered an exchange. It is now considered a conditional contribution. And you do want to disclose when you have conditional contributions, just as you have in the past. Okay. So moving on to our last example for transition. Again, implementing in 2019, and in 2018, this organization had received a 3-year grant with payments of $150,000 a year through 2020. Okay, so at initial award in 2018, the organization accounted for this grant as a conditional promise to give. So under the old rules, old definitions, old confusion of conditional or unconditional, this organization believed this to be a conditional promise to give. So they only recognized $150,000 in 2018. Okay. Again, we do not have a completed agreement. There is still revenue to recognize. So the organization needs to review this agreement against the new rules. All right. In doing so, the organization actually determined this is really an unconditional contribution. So maybe there wasn't, by definition, a barrier in this agreement. So it is considered an unconditional contribution. So what do they have to do? In this case, the remaining $300,000, that has to be recognized as revenue in 2019. Okay? Be recognized with donor restriction, and then you're going to release it in 2019 and 2020. But now, based on all of the new rules, the new definitions, if this is considered an unconditional contribution, you have to pick up all of the remaining revenue. Okay? So these are really just three examples that could apply to any organization. The piece to remember is at the effective date, what agreements do you have that are not complete? Which still have revenue to be recognized or earned? For those, each of those will need to be reviewed to determine, proper revenue recognition treatment, either under the ASU 2018-08, grants and contributions, or Topic 606 for exchange transactions, or maybe even both. So that's the piece to remember or to think through for the transition is for any of those uncompleted agreements or new agreements, you're going to have to analyze those.
Okay, thank you, Alyssa. I am just going to go through a few implementation tips here before we wrap this up. You're going to want to consider all of your revenue streams and how they fall within ASC 606, that 5-step process, or ASU 2018-08, where we have to consider conditions and barriers. And you're going to determine also what you can group versus what you've got to look at separately. And then for each significant exchange transaction or group of transactions, you're going to analyze those and you're going to document the results of each of the five steps under ASC 606 and include the final determination on how you're going to recognize revenue. We recommend that you document this out, that you walk through those 5 steps similar to how we had them in our presentation and really lay all of that out. And then for each of the non-exchange contracts or the contributions that are coming in under ASU 2018-08, you're going to want to review for any conditions as opposed to restrictions. And I think the other thing you're going to want to do is you're going to need to, once you've identified these revenue streams and the things that, especially in that 5-step process, you want to look at the internal processes and the controls, your IT systems. Do you need adjusting in order to track information? In Alyssa's museum membership example, there were some things in there that you're going to have to track somehow relating to members so that you know how to recognize your revenue. And then lastly, are there new or revised estimates that are involved that require consideration? So we talked about some estimates, again, in the membership example that Alyssa went through. There were some estimates that we did based on, for example, the number of classes that we think a member takes. Those estimates may be revised each year. So it's something that you would want to track and consider, again, every year in your estimates. And when you're calculating the prices that you're going to allocate to each performance obligation. So those are the implementation tips that we have. We strongly recommend that you document these just so you have them for going forward. And if you're auditing, as Alyssa had mentioned earlier, auditors will ask for this. We will want to look at it and test it. So with that, I believe we're turning this back to Ray to wrap us up.
Great. Appreciate Alyssa and Lorri's knowledge on this topic, and hopefully everyone got something out of this. We did have a couple questions that we'll answer afterwards offline, and we'll get those questions answered. In addition, there's a variety of ways to contact CRI through social medias, and then or just straight emails to the marketing department, and they'll give you, if you have any trouble with CPE statements or certificates or anything like that. A little advertisement for our Southern Grants Forum. It's in July 21st through 23rd in New Orleans. It's a great way to earn some CPE and learn a lot of different things. There are going to be technical classes on the latest and greatest information, and there'll be other things, so like how to manage and find staff, investing your money, plan giving projects, ethics classes, just a variety of just to make your not-for-profit organized as efficiently and effectively as possible. So keep that in mind. You'll be getting some flyers on that in the future. So we want to take the time and thank you all for showing up. We're right at our hour, and we appreciate everything, giving us an hour of your time today. If you have any questions, just reach out to someone here on the call or your local CRI office, and we'll help you any way we can. Thank you.